Hi, I'm Matt Wacher. I'm the Chief Investment Officer for Morningstar Investment Management here in Australia, and this is our Morningstar Market Minute, which we release every Friday lunchtime, looking at a range of issues that have occurred during the week from a market perspective and from economics here in Australia and globally. Let's start with tariffs. Yet again, there've been a focus for markets this week. In fact, last Friday night, Australian time, President Trump announced that he was going to slap 50% tariffs onto European imports into the US. Trade talks weren't moving as fast as he was expecting or wanted them to. However, we saw by Sunday night, Australian time, that tariffs had been delayed. He wasn't going to implement that until July the 9th. And what we saw was markets start this week very strongly on the back of that news. We also saw later this week a US court was saying that they were going to block tariffs completely, a US trade court, and that meant that the tone for most of the week was very strong in terms of market movements. We saw S&P 500 moving back above the 6,000 mark. It's not all bad news around tariffs. We believe that the uncertainty that's being created by investors trying to understand the end point where tariffs are going to end up, it does create a lot of volatility, and certainly that means that we can take advantage of buying assets at much better valuations than we perhaps would have been able to. That's certainly been the case over the last 6 weeks. We were able, especially at the beginning of April, buy lots of names, for example, globally, names like Nike or Burberry, those consumer names that really got hit hard as a result of the tariff announcements, but also some of the bigger names out there, the US tech names that really sold off quite aggressively in the face of tariffs early on, but have bounced back quite significantly since then. One of those big tech names that certainly got a little bit cheaper, although not outright cheap valuations, was Nvidia. And it's certainly rallied very heavily over the last couple of weeks. Today, Nvidia reported yet again a fantastic result. Although it wasn't all good, there are issues around being able to supply chips to China and whether that will affect future earnings. In fact, over the last 2 years, Nvidia's earnings, as a chip maker, have been outstanding. We haven't seen the results like this for any other company. They've just been able to beat and beat and beat. But we are getting to a point where the bar is again set very high for Nvidia earnings, and maybe that bar will get knocked off again at some stage. Nvidia really has to justify the huge expenditure that its clients, its customers have been making on AI-related chips. And we really need to see some productivity gains there from the companies that are outlaying all of this capital that Nvidia has been able to benefit from. So it is a great company. Looks like it's going to be smooth sailing for Nvidia, but we do need to really see that earnings growth continue for it to be able to continue to outperform. While we don't have a material issue in Japanese government bonds, we do hold global bonds. We think that duration is still something that investors do want to own. However, we do have a reasonable position in the yen, and we think that the yen is reasonably valued, especially versus the US dollar, but also versus the Australian dollar. And finally, Aussie markets have been really driven by US and global markets this week. We did, however, have the CPI numbers come out. They were a bit worse than expected, only marginally. CPI numbers came out at 2.4% for the year versus 2.3%, which was expected. The markets are really still pricing in 2 to 3 more rate cuts this year at this stage. And while we don't think that, we don't have a path for how we expect interest rates to play out, we do think that even if there were a few more cuts, that the Australian market and Australian equities in aggregate are reasonably expensive relative to some of the other global markets out there. It's really being driven by names like CBA and some of the other banks that are quite expensive at this point in time. But both here and globally, especially with the volatility that's potentially out there, we think that there's lots of other opportunities that investors can get a handle on. And that's what we'll be doing in the coming weeks if we do see that volatility reappear.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.